Hello, greetings, and welcome to Dividend Blasters. This is our 88th video, and topic today is energy transfer, ticker symbol ET. The world needs more energy, and ET, in my judgment, is the perfect investment for dividend investors. I like this stock. I really do. I've got about almost 1,500 shares, and I've been building my position in this stock for a while. I like it for a couple reasons. It's cheap. It pays a nice dividend. It's reasonably consistent. They've been paying a continuous dividend for 18 years. They have a 3-year growth streak. They are what we would call a midstream performer, but I'm going to get more into that. But first, a disclaimer: I'm not your advisor. This video is for information and education. Reflects my own personal opinions, research, and experience as an independent investor for more than 30 years. So, what I'm telling you is not advice. Do your own research. Do your own due diligence. If you want, consult an advisor before making any financial investment decisions. So, what am I going to do? I'm going to do a couple things. I'm not going to jump right into the stock. I'm going to give you a little bit of a lay of the land of the energy sector first, because I think it's really important for me to do some justice to the stock. I mean, I could just talk about the stock, and be done in 5 minutes, but I think that would be not good enough. So I'm going to give you a little bit of background on the sector. I'm going to give you a little bit of what the outlook is for investing in oil and gas. But I'm going to talk about the sector and the different subsectors. And there's really 4 subsectors: downstream, midstream, upstream, and the integrated oil and gas company. And then I'm going to get into energy transfer, or ET, and talk a little bit about their background and their operations and their strategy. And I'll talk about their dividends and some of their financials. All right, let's press on. So, what is the outlook for investing in oil and gas? Well, I'll tell you what, it's better now than it was a year ago. We got a friendlier regulatory business environment. We have a presidential administration, President Donald Trump and his administration are much friendlier to oil and gas companies. Um, Much different. Basically, the last 4 years, nobody could drill. And we really had gone from, and I'm going to get a little political, but just forgive me, bear with me if you want. Um, Nobody could do any drilling, and basically, you had an administration that was hostile to fossil fuels, and they wanted to mandate EVs. Okay, mandate windmills, mandate solar. These alternative energy sources are good. We got to explore them, but we can't rely on any of these others. We're a oil and gas driven economic enterprise here in the United States and primarily in the world. Um, so it's fine to transition, but you have to do it smartly. So anyway, I hit that first point pretty heavy. Companies are basically becoming more thrifty. They have an increased focus on managing their spending. Capital investment is getting tighter. They're looking for higher returns from their projects. They want their cash flow. The industry is about cash, and these companies have to generate cash because you know what? Companies in the energy sector pay great dividends. Well, they need cash to do that. That's how they. That's not the only thing they need cash for, but that's an important thing. There is growing demand for oil. As there's more international and offshore spending for drilling. It's ramping up. Um, Companies are exploring low carbon technologies. So here you're basically looking at, again, low carbon alternative fuel sources or becoming more efficient in how existing fossil fuels are processed and managed. That's a good thing. This can ultimately, if it's done smartly, make the companies more efficient, more environmentally friendly, and ultimately more profitable. That's good for investors. We're going to see more consolidations through mergers and acquisitions. It's going to be basically driving effectiveness and efficiency. It's a very competitive industry. That's just how it is. What are the risks? There's geopolitical tensions. There's always geopolitical tensions. We all know what I'm talking about. I'm talking about the Middle East. We're talking about Russia and Ukraine. And Iran. I mean, there's just lots of tensions over there, and that can affect the price of a barrel of oil. How's it going to affect us? It's complicated. I can't say one thing will make the price of oil go up or go down, and that will ultimately make the price of the stock go up or down. It's complicated, and it's always complicated. Anyway, that's another risk. Trade policy uncertainties, tariffs. Okay, we know that President Trump is looking to leverage tariffs to re-level trade balances um, around the globe. Uh, Oil and gas are no exception. Um, I talked a little bit about this energy transition. Okay, EV is here. EV is not going away, but oil and gas is not going away. But EV it's a good thing. We can have both. We just have to have it smartly. But as EV begins to ramp up and the adoption rates increase, and then of course renewable energy sources increase, that will have some kind of a pressure, if you will, on the price of oil and gas. So that could have an impact on our investments. It's just something that we need to be wary of. So essentially, what do we do? Well, I'm all in on oil and gas. I'm in on lots of sectors, but oil and gas I find it to be very useful. As I said, the economy is very dependent on oil and gas. Not only having to me as an investor, having a diversified portfolio across multiple sectors, I think it's good to have some diversification of performers within oil and gas. So I own upstream performers, midstream performer like E&T, but also integrated oil and gas companies. And having that diversification, I think, is good, especially among the large integrated oil and gas performers, because they really have economies of scale, and they can continue to generate nice dividends. I like ET, which is a midstream performer with connections to upstream and downstream, because it's a cheap stock, but they're very well regarded, and they pay a nice dividend. And so I like it. I like adding it to the portfolio. That's why I'm sharing it with you. Volatility, that's not going away in the sector. It's always going to be there. Last year, overall, the market sector, I think it performed a little under 6% total return. It's not bad, not great. In 2023, it was down below 0%, 1.33% loss. They got hammered badly in 2023. Most of the performers, so overall at the aggregate level. So it's just important to be wary and to be diligent in where you invest and how you invest. And I'll just be very candid here. I have several hundred shares of Chevron. I have almost 1,500 shares of ET, and then I have smaller holdings in Shell, in British Petroleum. I have a couple hundred shares of Sunoco, which I like, and a few others, and I'll talk a little bit more about those later, but they're smaller amounts. Okay. So, I find it interesting to see how the sectors stack up against each other. Energy does well. As far as average aggregate dividend yield, energy is number three of the 11 sectors, with a range of anywhere from 5 to 12%. And why is it such a wide range? It really depends on the subsector. We can talk more about that later, but some subsectors pay better than others. Um, I will tell you that Energy Transfer has a very decent yield. It's not 12%, but it's a lot more than 5%. It actually pays more than ExxonMobil. So that's another thing I like. So anyway, but utilities is at the top, followed by REITs. But REITs has a very wide variation in its yields. What you'll find with utilities and REITs, they don't grow a lot. They're very steady. price appreciation, kind of flat. Energy has a little bit more volatility. So now it's good to own utilities. I own, you know, one utility or two. I own Dominion Energy and Gen or Next Era Energy. Those are fairly flat, but they pay nice dividends. I own a couple of REITs, and I don't want to get into that now. It's a whole different video. Financials then follows energy, so basically the banks, the credit card companies. Credit card companies kind of bring that average down. The banks tend to be a little higher. Materials like Lyondell Basel, not a bad dividend. Consumer staples, and then when you start to get into communications and industrials, it goes down a little bit. Um, but anyway, I could talk about every single sector here in the stocks that I have. I'm very fond of the industrials and of course financials. When you start to get to technology, the dividend yield gets very modest. But a lot of these high performing tech stocks, they you don't buy them for the dividend, you buy them for the growth. Healthcare, really the same thing. You're looking for the company that uh, is going to generate the next wonder drug, or hopefully you got into the Eli Lilly before they came out with the diabetes or the obesity treatment, shots, which Eli Lilly has done very well the last few years. Okay, but you can see how they stack up. Energy really stacks up very nicely. Okay, so let's talk about the sectors or the subsectors of energy. Really, at the very beginning of the supply chain within the energy sector is upstream, and that's basically the companies that are doing the resource extraction. They're getting the oil out of the ground, or they're getting the oil and gas, liquid gas out of the ground, or they're getting it out of the ocean floor, and they're doing the production. Then midstream, and that's where ET plays, and that's basically they do transportation and they do storage, and they have the relationships with the upstream producers, extractors, and producers, and then they get it and they store it, and they do the transportation through trucks and through pipelines uh, to the downstream performers that do further refining, and ultimately they do the retail, so the gas stations. I'll talk a little bit more about the downstream too, particularly Sunoco, and they're mostly they're a midstream, but they are very visible in the downstream subsector. And then, of course, you have the integrated oil and gas companies, and these tend to be the very big companies that do um, activities and operations across the other three subsectors. And you typically have to be a really big company, and these are very powerful companies that can control major aspects of the supply chain, and they have economies of scale, and so they can have less volatility in their business model, and ultimately less volatility in their stock price. And I'm not going to talk about utilities. That's a whole different video. But there are touch points between energy and utilities. Okay, so upstream, these are the companies that are doing the extraction, really also the exploration. They're looking for where the oil is. They want to be very spot on. They don't want to spend a lot of time digging and mining oil and gas where it doesn't exist. It's a waste of time and money. So they do exploration, they do the extraction, and they ultimately do the production. They do a lot of drilling. They extract crude oil and natural gas. Their focus is on discovering reserves and bringing raw hydrocarbons to the surface. And who are the major upstream segment performers? Well, very familiar names: ExxonMobil, Chevron, Conoco, Phillips, EOG Resources, Occidental Petroleum, or Oxy. So I own several hundred shares of Chevron. I used to own more of Conoco. I own less now. I don't own any ExxonMobil. I used to. I thought Chevron has a better dividend, uh, so that's why I like Chevron. I don't. I did own Oxy briefly. I have some Devon Energy. I have some Diamondback. Um, I used to own Marathon and Coterra. Don't own them anymore. Okay, so that is upstream. So let's go to midstream, and this is where ET plays, and this is primarily transportation and storage. And how do we define midstream? Transportation, storage, and wholesale marketing of crude oil, natural gas, and refined products. What is the role? Basically, midstream connects upstream extraction to downstream refining and consumption through their infrastructure. What is their infrastructure? It's their pipelines, but they also have trucks. Okay. They also have ships too. Uh, Examples: pipeline transportation, storage and terminals, and liquid natural gas processing. They process natural gas into liquefied natural gas or natural gas liquids. You can hear more about that in GLS. All right. Major performers in midstream. Energy transfer, of course. As I mentioned, I have about 1,500 shares of Energy Transfer. Enterprise Products, I do have some shares of Enterprise Products Partners. I have some shares of Enbridge, not a lot. Um, and we go down to the second list, and what do we see? We have Sunoco. Well, we're all familiar with Sunoco. You go to the gas station, you buy gas. I had always thought of them as a downstream performer, but they're really a midstream performer, but they have significant uh, downstream operations. And why am I calling them out? Because ET has significant ownership of Sunoco. So something worth mentioning, as well as USA Compression Partners. And what is compression? Compression is basically a way to regulate the flow of oil and gas through the pipeline. Keep it moving. Keep it moving. You don't want stuff just sitting around. You want to keep that oil and gas moving efficiently. Okay, downstream. Okay, this is probably the one a lot of us are most familiar with. We go to the gas station, we buy gas. It's a portion of downstream. Let's drill down a little bit more. What is downstream? It's really the refining of crude oil, processing natural gas, and marketing and distributing finished products to the end users. Okay, so it's refining, it's processing, and distributing to retailers. And basically, a lot of the retailers are solely downstream. Some of them do marketing to themselves, or marketing to, colleagues that also just do solely distribution. They have to get the gas from somewhere. So basically, what are they doing? They do some processing. They're transforming raw resources into usable fuels and chemicals. They deliver it to consumers. So there is some refining going on. They do converting of crude oil into gasoline, diesel, jet fuel, etc. They do retail marketing. They sell fuel through the gas station, utilities, and direct contracts. Petrochemicals, they produce chemicals from hydrocarbons, okay, plastics, fertilizers. So that's really downstream in a nutshell. And who are some of the major downstream performers? Valero Energy. I've been to their gas stations. They're pretty prominent as you go out and further out into the country where I am. Phillips 66, same thing. Shell is everywhere. BP, Sunoco, Shell, BP, and Sunoco are what I would call, and you're going to see them again, are integrated oil and gas companies. But they're here, they have a significant downstream presence, if you will. Murphy Oil, it's primarily downstream. Suncor Energy, another one. All right, let's talk about integrated oil and gas companies. And here is a nice graphic or visual that shows the supply chain. Very simple. Upstream is primarily exploration, and then of course they do production. Midstream does some production, and then there's a further refinement, and then there's ultimately distribution. Um, and so, is this a complete graphic? No, but it kind of gives you a thumbnail sketch of that. I'm going to go a little deeper because I'm going to talk a little bit about ET's uh, value chain, if you will, a few slides down. But who are some of the major? Well, let's define it. Let's define it. The integrated oil and gas companies. These are the bigger companies. They operate across at least two segments. So remember, the segments are upstream, midstream, and downstream, and they control often the full value chain from extraction, getting the oil and gas out of the ground or out of the ocean floor, all the way to the retail, right, to the gas station. That's a massive amount of control. And so companies that can do that can really control a lot of their operations and manage volatility and have economies of scale in their operations. They got diversified revenue streams because these different segments they all generate revenue. They all have their own expense and they all have P&L sheets. So they have these diversified revenue streams, as I mentioned, reduce volatility. They can leverage economies of scale. Vertical integration, very important. You can own assets in extraction, but also in pipelines for the transportation, the further refinery, and then gas stations. So I talked about extraction, transport, processing, and then marketing and distribution. So who are the major performers? Again, these are the big boys: ExxonMobil, Chevron, Shell, BP, formerly known as British Petroleum, Total Energies, Conoco, Phillips, Saudi Aramco. It is a huge, huge oil and gas company, largest one in the world. Okay, headquartered in Saudi Arabia. All right, let's do a little deeper dive into Energy Transfer (ET). This to me is close to a pure play midstream segment leader as there is. It's one of the largest and most diversified midstream energy companies in the country. They have a significant focus on transportation, storage, and what we call terminaling of natural gas, crude oil, and natural gas liquids, or NGLS, and refined products. So here's the graphic. I was talking a little bit about their value chain, and you can just basically see that they're the blue part in the middle. They're the midstream producer, and you can see upstream to the left in kind of an orangey color, and then downstream in green. ET is in the middle, and for crude oil, they're doing a lot of gathering through their pipelines and their trucks. And they're collecting oil from well sites where the upstream provider is, and they transport it, hopefully nearby, to storage tanks. And they're going to store it, and then they're going to transmit through pipelines over long distances, often across state lines, to large storage terminals and third-party refineries. And ultimately, um, there's going to be a final transportation through the pipeline or through trucks to move crude oil and refined products, ultimately to a third-party distribution hub or a export facility. It could be gasoline, jet fuel, diesel, or whatever. Okay. And then here is another graphic, and that's crude oil. This here is natural gas. And it's primarily the same thing. You know, they have their connection to the upstream provider as well as to the downstream provider. They got pipelines where they're providing transportation um, from all of the major U.S. basins to local processing and treatment facilities. Okay, and they're basically doing some initial processing where they're separating out what we call hydrocarbons and fluids from the pure natural gas. Why do they do that? Because there's spillover products that they can go ahead and reuse and sell and make money off of. I'm going to talk a little bit about that. Um, so basically, after natural gas liquids or NGLs, there is ethane, propane, and butane, which are removed from the natural gas stream and they're separated into their own components at other plants, fractionation plants, is where they do the separation. Then they do a further transmission and compression through these large pipelines, often going through interstates, many states, where they're moving natural gas long distances with the help, I talked a little bit about this, compression facilities that compress and push the gas forward, keep it going. Very important to be efficient in moving the gas. And then ultimately, they have storage and transportation facilities, basically where they're transporting it and maybe holding it, and then maybe doing further transportation to a third-party company to distribute the products directly to homes and to buildings. So that should give you some thumbnail understanding of the value chain. As I said, this is as close to a pure play midstream performer as you can get. Uh, if there's a major takeaway from this slide here, is that they are growing. Their 24 revenue was $95 billion. They had an increase in demand, so it could only go up. So they just had to keep up with demand. One thing I will say is that they have had to upgrade a lot of their facilities through an increased capital expenditures. They had to increase their debt, but they're beyond a lot of that. They're paying it off, and they're doing very well. Their net income in 2024 was 6.6 billion, it was up 24% year over year. Um, and why is that? They had asset sales. They also had prior year litigation losses that they had to address in previous fiscal years. They're beyond that, which is great for us investors. Their EBITDA was 15.5 billion. It was a record for the company. It was up 13% in 2024. So that is a record. Um, Outlook for 25 is expected to be over 16 billion. So that is all very good news for Energy Transfer. Just some high level information. They were founded in 96, headquartered in Dallas, 16,000 employees. Pipeline miles, I think this is very important, 125,000 pipeline miles. That is huge. This is a very active and robust company. These pipelines spread across multiple states. Their strategic focus, transportation and storage, but also looking to diversify and build their capabilities around renewable energy sources. And expansion. I mentioned the capital expenditures. They had to keep up with demand. What are some of their key assets? Natural gas, crude oil, NGLs or natural gas liquids, refined products, pipelines. Pipelines is huge for them. Uh, Terminals and storage. Major investments. Sunoco. I talked about how they're a retailer. USA Compression. They're very important in compressing and moving the natural gas through the pipeline. And Lake Charles liquid natural gas. So I did talk a little bit about the separation and fractionation of the natural gas. This is very important because you're really talking about a valuable byproduct that can be further processed into other products like plastics, synthetic rubbers, and fuels, and they can sell that. That to me is a free resource. So that to me is absolutely golden, and that they're taking advantage of that. I already talked about the network and the pipeline, natural gas, crude oil, NGLs. I talked a little bit about the refined uh, products. So you can read this stuff. There's, I'd say, interesting metrics. If you read this stuff, you'll find out about BCFD, or billions of cubic feet per day, which is a unit of measure in the oil and gas industry to express the volume of natural gas produced or consumed or transported. That's a very important metric for a midstream producer that's doing a lot of transportation through pipelines. And then another is MMBLS, which is millions of barrels, unit of volume, basically that measures large quantities of crude oil um, produced, transported, whatever. Already talked about Sunoco. They have basically a significant ownership in Sunoco. It's called the general partner interests. They have incentive distribution rights and a significant stake in a larger company. Okay, we all know that they are a distribution and a retailer. USA Compressions, they own a significant stake in that regulates the flow of natural gas through the pipeline. It is so important that they have a significant stake in this performer within their value chain because they can exercise some control and manage some of the volatility in the industry. So these guys are really doing it right. They have a 100% stake or a full stake in Lake Charles LNG. It's an import terminal and a regasification facility. Uh, Very important. I already talked about Sunoco. I talked about the compression play that they have. So I'll read that. What is their strategic footprint? Well, geographically, they're in 41 states. They cover all major U.S. production basins. They got nationwide connectivity to serve a wide range of customers in the downstream, including utilities, independent power plants, industrial end users, and export markets. Market share is very nice. 25 to 30%, 35% of all U.S. natural gas produced, and nearly 35% of all U.S. crude oil. They transport all of that. So they are a big player in the transportation of this stuff. They export about 20% of the world's NGL exports. They're a global leader in this segment. Growth strategy, well, they're growing through acquisitions and expansions, both organic. They recently purchased a company called WTG Midstream, which added about 6,000 miles of gas gathering pipelines and 8 processing plants. That's pretty significant. They have a joint venture with Sunoco. I already talked about that. But this is interesting. It's not just ownership, but this joint venture where they're combining crude oil and produce water gathering assets in the Permian Basin. And then also they're looking into alternative energies. They're expanding the renewable energy products, including solar and wind power purchases. You know, we can't just have one source of energy. We got to have multiple sources. We have to be diversified. The world is changing. We have to do it smartly. And these guys are doing it smartly. So a little deeper dive, and this is what we like as dividend investors to get to the nuts and bolts. ET closed Friday, June 20th at $17.85 a share. As I said, they're cheap. Just take a quick look to the right. The PE ratio is 12.7. That is, to me, is very nice. Now, the energy sector tends to be less than the wider market of the S&P 500, which is, I think last time I checked was 22 or 23. That's a little bit hot. This sector's been deflated, but I think it's a good buy. I do like the dividend yield of 7.34%. So this is a higher yield than ExxonMobil and some of the other big ones. But I'll talk a little bit about the dividend growth rate. It's a little bit more modest, but the yield tends to be high and it tends to stay high. It'll go up and down a little bit. It's not going to continually grow, but they do have a 3-year growth streak going on with the dividend. Seeking Alpha rates them green. Okay, their analysts give it a buy rating. The quant team gives it a buy rating. Wall Street is really bullish on ET. They give them a strong buy rating. All right. I already mentioned that the dividend yield is 7.34%, or dollarized, $1.31. It's a quarterly paying dividend. The growth rate of the dividend is 1.2%. It's kind of modest, but it's a higher yield, so it's not surprising that it's going to be lower. The current growth streak of the dividend is 3 years, but they've been paying a dividend for 18 consecutive years. It just tends to fluctuate, but they're on a 3-year growth streak. You can see the dividend yield history there. Freeze the screen and read it if you like. I already talked about the 3-year growth streak and the 18-year streak of paying dividends. I would say the major takeaway here is growth. Revenue growth is up almost 7% over the last year, much more than the sector median, which is less than 3. EBITDA growth, almost 10.5%, 10 times that of the sector. So these guys are growing. I like that leverage free cash flow growth, 4.43%, whereas for the sector, it's slightly negative. And, as dividend investors, we're always interested in what the cash flow is. Profitability, okay, not bad, not bad. I tell you, 19.43%. The sector median tends to be higher, and I think it's higher with some of the bigger companies, the companies that can control more of their value chain. But look at the EBITDA; it's closer, much closer than the profitability is. Now, remember, this is trending 12 months. Let me actually caveat this. These guys over the last 12 months have been coming out of some litigation, and so that did affect their profitability. If I were to look at the forward profitability, which is actually not on this slide, it would be higher. So they are coming out of that. But look at EBITDA; it's much closer to the sector median. And levered free cash flow margin, I like it. It's almost equal. This is for the trending 12 months. So even with the litigation, that is a decent trending 12-month levered free cash flow margin. All right. And folks, that is it. I hope you found this to be useful and enjoyable. Um, Thanks for sticking with me. This is a little bit longer video, but I thought it was needed to do it this way. I'd remind you that as an affiliate partner of Seeking Alpha, you can take advantage of a discount, and there is a sale going on through July 11th. It's the Seeking Alpha Summer Site-Wide Sale, where you can get 20% off any of these subscriptions, the premium, Alpha Picks, or the bundle. Premium is basically you're going to get 24/7 stock prices, insightful analysis of stocks and ETFs, industry trends. Alpha Picks, you're going to get a new couple of picks of stocks regularly. And you will also have the opportunity to get the bundle, which is both. And again, these are all 20% off. So dollarized for premium, you're looking at $60 savings. For Alpha Picks, $100. If you get the bundle, $160. You can see the QR code there, and or you can just copy the link and go right to the deal, sign right up. One thing I want to say about premium is, in addition to the $60 savings, it's a 7-day free trial. You try it for 7 days. If you don't like it, you cancel it. But I tell you, I'm a long-term subscriber and a customer of Seeking Alpha. I have premium and Alpha Picks. I've had it for years, and I've been an affiliate partner for the last year. And I truly, truly believe in this online digital investment analysis resource. I think it's just phenomenal. And here's a little bit more detail on premium and Alpha Picks. And you know what? If you're interested, check me out on other platforms. I'm on X, Instagram, and Facebook. And folks, that is it. Have a wonderful day. And for our next video, God bless.